Let's bring in Michael Morris, Guggenheim Securities Entertainment and Media Analyst. Michael maintains a buy rating on WBD and a price target of $14. Michael, what do you make of today's move and the results from WBD?
Sure. So the move in the stock is clearly the topic to be discussed right now. The results themselves were not great, but I don't think they were really surprising. The places where the performance in the fourth quarter was a bit softer, primarily at that studio segment, where the street already knew that these films had underperformed. I think they were well prepared for the numbers as they came out. Where I think that people are surprised right now is the lack of full year 2024 guidance. This is a company that historically has provided formal guidance for its coming year performance, and not providing that guidance today, I think, surprised a number of investors. That guidance usually is EBITDA, profitability, also free cash flow. The company talked about a number of qualitative factors, but without that quantitative commitment, it's hard for investors to make the commitment.
So is that partially due to uncertainty surrounding advertising? I saw 14% decline in linear television advertising revenue, excluding changes in FX, and a 4% drop in distribution revenue. So does that say something just about the cloudiness of the advertising picture right now? And as an analyst, how do you model that moving forward, given your current buy rating?
Well, yes, on a number of things. So first of all, I'd say I model it regardless of what my rating is. I'm happy to come back to that topic as well. But the important thing here is that we, the investment community, the media community, we understand that the environment is challenged. We see consumer behavior and advertiser behavior. So we know these things. In the case of Warner Brothers Discovery, they have a plan. That plan is to have a direct-to-consumer business that they are migrating activity into and hopefully migrating economics into, right? But somebody at some point has to say, this is what we think we will do in the coming year, right? We know there's uncertainty. We can talk to you about some of those uncertain factors, but we still believe we can perform at level X. If you think about when this company merged, when they created this company 2 years ago, they provided us with formal outlooks for multiple years for revenue, for EBITDA. You have to make those types of commitments, even in the face of uncertainty. And so to not do that, it shakes investors' confidence. You can talk about qualitative factors, like I said, all you want. You could talk about, use the term momentum. But if you don't make the commitment to what you think you can do, even in an uncertain environment, like I said, it's hard for investors to be confident in that. To answer your question about how I model it, and I'm happy to talk more about this, we take a pretty robust view of the market. We dig into what's happening in the advertising market at large, what's happening with consumer behavior, and we make our determinations. We do think 24 should be better than 23, but we do also still think we'll be challenged.
As far as the qualitative title work, I guess, David talked a lot about the Superman film. They talked about Wonka. They talked about Harry Potter. Is that enough for any would-be bull to chew on?
I'll say yes. I'll say yes, it is, especially with the stock where it is right now. So let's put a couple of things together here. When I think about my buy rating on this stock, and I think about the value of this business, a couple of those titles you just mentioned, they're indicative of the strength and health of this company. It is one of the strongest producers of content in the world. It's one of the strongest owners of IP in the world, including those franchises you just mentioned. If you are going to be successful in this challenging and evolving marketplace, at the core, you have to have great content. And I do believe that the foundation is there. And that's why one of the reasons, not the only reason, but one of the reasons that we've been positive about the stock. But from there, you have to execute. You have to make content that's great, even using that IP that is commercially successful. And you have to have a strategy with respect to how you window that content theatrically on your streaming service, whether you sell off platform, that drives growth. And so far, and in fairness, it was a challenging year in 2023 with the strikes, but this company has not delivered against that. Okay, many media companies have not. They are not alone, but if they want to win and if we want to see that stock appreciation, they have to hit those marks.